So let's quickly get you the other stock that is in focus, and that is Raymond, really, because the stock has been a stellar performer on the back of its numbers which it posted. The stock is up 5% at about 419. And just to analyze the numbers and review the numbers, remember the company posted a revenue growth of about 7% and a PAT growth, profit after tax growth, of 162% increase at 56 crores versus 21 crores. EBITDA was up 46% at 176 crores, and margins came in also much better than expected. What has driven these numbers? Well, I have the management joining me right now. I have the CFO Sanjay Bahl with me. Sanjay, thanks so much for joining us. Let's start off with the numbers itself. What led to that sharp pickup in profit and in the fourth quarter?
If you look at the results for the quarter and for the year, we've seen improved performance across our key businesses. Primarily contributors have been really what has been a strategy for sustained investment in brand, our retail network, coupled with operational and sourcing efficiencies that has resulted in the improved performance across our core textile and apparel businesses. In particular, our B2C shirting business grew by 32%, driven by channel as well as product portfolio expansions. The textile has witnessed improvement in margins, and which has also got the benefit of lower raw material prices prevailing during the year. If coming to the apparel business, this has grown at 15%, and we have seen this now happening over the last 8 quarters. So it's a matter of now testimony to the strategy that we have on investing in brands. All brands within the apparel business have registered double-digit growth, and that's a very encouraging sign for us. Our strategy on brands positioning has played out very well in the last 1 year, and our growth has exceeded the market growth rates. EBITDA for apparel business for the quarter improved year on year, driven by the operating leverage and the scale that we are now getting. Coming to the garmenting business, we saw improved offtakes in the last quarter, and this has also resulted in better EBITDA performance. Finally, on the non-core businesses, the engineering business, the efforts to restore profitability through product rationalization, cost reduction initiatives are now showing early signs of improvement. So overall, all these factors have led to an improvement in performance for the quarter and year.
Give us a sense of the margin picture as well, because there has been a fair amount of growth. Is it because of raw material costs coming in, or operational improvement and pricing improvement as well?
It's of multiple factors. The improvement is because of sustained initiatives in operating efficiencies in the plants, lower energy prices, lower commodity prices, and also better price realizations through product and portfolio mix in apparel as well as in the textile segments. So it's a mix of all these factors.
Let's look at the cotton prices themselves. Has the best of that been priced into margins, or do you still expect an up move in FY17 going into this financial year?
See, we have got the benefit of lower commodity prices last year. Wool and polyester prices have also declined in the range of 2 to 4%. Going forward, we expect stability in the commodity prices. And both on the utility side, on the oil prices side, as well as on the raw material side. So it is expected that these will sustain.
Let's look at the operations themselves. In what segments are you seeing higher traction?
Same-store sales growth because of the subdued customer sentiment, and also the end-of-season sales, which have got extended last year, has been in single digits, low single digits, around 3%.
What is the picture that's emerging there for same-store sales growth? Do you think it's going to be as tepid, or do you see a pickup there?
For next year, the expansion plans will continue. We have added 85 stores this year in 15-16, and for next year, our expansion plan will be the renovation plan will continue, and we will continue to invest in our branded apparel exclusive outlets, and we should be looking at adding another 70 stores.
You are in the process of revamping your distribution network from what we understand. What's the update on the same and what is the kind of allocation you're looking at over there?
See, we already have one of the strongest distribution networks in the country today. We've got 1,051 stores and we will continue to invest in the channel. The main focus will really be to renovate our existing the Raymond stores that we have. We have a massive spread across from tier 1 to tier 5 towns, and the effort will be to revitalize these stores, renovate these stores, and the positive sign that we see is post-renovation we see growth of nearly 20%. So the effort will be to continue to do this.
Last question, Sanjay, what is the outlook for the new financial year, both in terms of bottom line and top line?
See, while I will not be able to give you specific guidance on the numbers in terms of margins and volume growth, but as I said earlier, the strategy will be to continue to do what has worked for us in 15-16. The increased focus for next year will be on the Raymond ready-to-wear business and MTM network expansion. And the other segments where we have already invested, which is shirting and denim, we will see increased capacity utilization. Garmenting, we also invested in capacity. That will see a higher capacity utilization for next year. So overall, volume growth that we see for apparel should continue in double digits, and for our suitings business should be a volume and value growth in single digits is what the expectation would be.
Right, Sanjay, thanks so much for joining us. That's Sanjay Bahl from CFO of Raymond. Let's slip into a short break. Up next, we discuss earning expectations on Bharti with Bhavesh as promised, and we'll also be cutting in live to the Yes Bank press conference.